Today is Tuesday, October 13, and this is a post-market review for the stock market activities today. Lots on the agenda today. We do have a lot of news to cover. We will cover the earnings of the day from JP Morgan, Citibank, and Delta Airlines. And in addition, we will review the Apple event and the new iPhone 12. We do have some charts today for the SPY, the Qs, the VIX, dollar index, gold, and here is a new development in the TNX in addition to Apple. And here we go, the diamonds in the red by 157.71 points or a decline of 0.55%. The Nasdaq in the red by 12.40 points or a decline of 0.10%. S&P 500 in the red by 22.29 points or a decline of 0.63%. Here is the sector's performance. Pathetic across the board and not worthy of giving any medals. With that being said, communication services and consumer cyclicals managed to finish the day in the green by just a little bit. Communication services, of course, was led by Verizon and T-Mobile due to the 5G announcement from Apple, but we also had an announcement from Netflix saying that from now on they will cancel the free trial that you used to offer. You either buy the service right away or you don't. And we saw shares of Netflix rallying in the last hour of the day. Now, the lagging sectors of the day, led by real estate, financials, and energy. And moving on to the futures market performance. We see weakness across the board for metals due to the rise of the US dollar today. Big declines for silver and palladium in specific. But we also have news of the increase in Chinese imports of iron and copper, so the long-term picture for copper remains bullish. However, it will trade on the tune of the US dollar in the short term. Meats, muted, grains, we saw gains in grains in soybean oil rebounding today. What about softs? We see gains in coffee. We had an entry in the December contract at the 107 price and it is working so far. OJ sugar in the green. What about coca? Not doing so good. Coca been downtrending for a while now. And moving on to the big casino, the options market. Let's see how the tables did today. Apple at number 1 with an absurd volume yet again. 3.7 million contracts traded today. About 73.5% of those were calls. Tesla at number 2, per usual, 577,000 contracts traded today, and about 70% of those were calls. At number 3, Bank of America reporting earnings tomorrow, 403,000 contracts today, 73% of those were calls. Right away, you see the gambling mentality in the market. We saw earnings from JP Morgan and Citibank, and we saw the entire financial sector trading in the red, including Bank of America down over 2% today. And of course, the autopilot programming for zombie traders is if things trading down before earnings, that means they will pop after earnings, so you buy calls, which is not always the case. But needless to say, we are not in a stock market anymore. We are in a casino. You could argue that it always been a casino, but I've been trading for a very long time now, and there was always an element of gambling in the market, but it was never 100% a casino like we have today. What about the volume leaders for the day? Apple, across the board, all what they're doing, of course, is rounding up to the next higher strike price. They're all calls, of course. They're buying the 125, the 130, and even beyond. And of course, as expected today, we saw sell the news phenomena in Apple. We talked about that yesterday, and you saw it happen today. So most likely, all these calls will expire worthless. Moving on to the change of open interest, beginning with the increase in open interest. And here we go, an interesting trade for Uber, buying the $25 put expiring 2022. Now, you can't read much into this trade. It is periodic for banks and big options riders to do this every time and then. But here is the point. I did buy Uber 35 puts expiring in November. And here is the thesis, of course. We do have a proposition here in California that will require Uber to treat its drivers as full-time employees. I believe it's called Proposition 22, and we are being bombarded by ads from Uber, Lyft, and the rest of the industry urging people to support the mandate to keep drivers independent. I haven't made my mind yet, but it is obvious, of course, that if the proposition is voted down, that Uber will suffer significantly and the shares of the stock will drop down by a big margin. So the psychology here is the uncertainty. We know that you should never underestimate the stupidity of the average Californian voter, because we've been voting against our own interest for the last 50 years. Now, like I said, I haven't made up my mind yet whether I'm supportive of the proposition or not, because supporting the proposition means that Uber will stay in business and the increase of costs on Uber will not be passed to its customers. On the other hand, the no side of the proposition basically says you have to pay your drivers full-time wages plus healthcare, etc. Now, we do know that Uber has a plan to replace all their drivers with robotaxis, and voting no on this proposition will just accelerate that goal. So why not, since we know that they will replace all the drivers with robots anyways, why not we just milk them down on our way out and let Main Street win this time around for a change? And you see, of course, celebrities like Better Call Saul saying that he's gonna vote no, and you will see a lot of woke celebrities doing the same thing. So there is a lot of uncertainty, but the psychology is for Uber holders to take profits right now because you'll never know. So what happens with my trade buying the 35 puts expiring in November is I will keep them all the way till election day. And before election day, assuming the trade goes my way, and Uber declines, I will lock my profits and close the options, regardless of the outcome of the vote. But back to the options market and the change of open interest, specifically the increase, we see the Apple 130 call being bought significantly today. And of course, if things go as we expect, these will expire worthless because they're expiring this week. Moving on to the change of open interest, the decrease this time. And we see here, and this is very important, Apple calls the 113.75, 115, 117, even the 120 being closed. So a lot of traders who participated in the pump are now dumping, unlocking their profits. Yet the zombie mentality is still there, and you saw traders, of course, buying the 130 calls today. And this is what makes a market, of course. Now, we also saw a decrease in the open interest in Morgan Stanley, the $50 put. And of course, keep in mind that Morgan Stanley will report earnings on Thursday. So perhaps traders here closing the bearish bets, specifically after the decline in the overall financial sector today. And we will see if we find out bullish bets for Morgan Stanley. That would make sense, closing the bearish bets and opening bullish bets for Morgan Stanley and Goldman Sachs, by the way, because we've seen the trading revenue increases in the banks that reported today. And speaking of Goldman Sachs, let's move to the interesting trades we found today. We do have the puts, the 197.5 puts, and the 22.5 calls being bought today. Those, of course, expiring by the end of the week. So traders are expecting a big move of 5 to 6% in Goldman Sachs shares after they announce earnings tomorrow. We will see which side is right. I'm not going to play that game. I will wait for Goldman Sachs earnings and the reaction of the stock, and then perhaps make a bet for Morgan Stanley instead. Moving on to the heat map analysis. Right away you see the decline across the financial sector, yet we see huge gains in the tech mania bubble. That is, of course, PayPal and Square. You also see BlackRock in the green today. BlackRock had impressive earnings report. And of course, it is a no-brainer that when the stock market does good, BlackRock will follow as well. Disney, Netflix in the green. Netflix, of course, we talked about the news right before the closing bell about Netflix canceling the free trials. Disney, we had news after the bell yesterday about their streaming service, and of course the market took that as a bullish move. Zoom, we talked about Zoom outperforming this week. This was the expectation, and here you go. Zoom outperforming today, along with names like Wayfair and smaller software momentum names. Small momentum names outperform big momentum names, aka big tech. Yet the laggards of the day from the heat map, you see Eli Lilly. We had bad news from Eli Lilly and Johnson & Johnson, both trading in the red severely today. We talked about banks, but check out the travel sector, severely in the red today, along with hotels and casinos. All the reopening stocks in the red due to the news, of course, that we will cover in just a little bit about the vaccines from Eli Lilly and Johnson & Johnson. In addition, of course, we had Royal Caribbean declining significantly today because they've offered over $1 billion in new shares, and that, of course, will dilute the value of the stock. So double whammy here for the cruise ship industry. Moving on to the rotation trade. Right away, and as expected, you see that momentum stayed home names outperformed today. Not by much. The performances were not very impressive, with very few exceptions, of course. You saw Apple declining, Netflix and PayPal doing better, but you saw Zoom, as I explained to you in the weekly Outlook video, that Zoom will outperform specifically Peloton. And perhaps you'll see Peloton starting to decline tomorrow and thereafter, because I've seen increase in implied volatility in the put options for Peloton. What's going on in the other side of the aisle? The reopening stocks or the lagging stocks? Right away, you see the reason why I chose Southwest in this list from all the airline carriers. We did have a bad report from Delta, and you saw airlines across the board severely in the red. Southwest, yes, closing in the red, but not by much, outperforming. And I will tell you the reason why when we cover Delta's earnings. But Southwest is starting to look like a buy here. What about Royal Caribbean? We talked about that. Big whack on the head. And you see Disney outperforming in the sector. But names that outperformed last week, such as the beer, here Budweiser and Planet Fitness, declining and giving up some of those gains from last week today. And now, moving on to the headlines that shaped the day. And right away, we've heard from Eli Lilly that they're postponing one of the trials, the vaccine trials. And also, we've heard overnight from Johnson & Johnson due to a negative reaction from one of the participants in the trial. That, of course, had implications specifically on the vaccine rotation trade and the reopening names in the market today. Moving on to the stimulus fiasco. What's going on? Any updates? Yes, we do have updates. The president, of course, on Twitter announced on stimulus to go big or go home. So I guess we're going home because Nancy decided to reject the president's offer, saying that it is not sufficient and falls short. Of course, Nancy wasn't interested in a deal to begin with. She's not going to hand the president a win a few days before the election. This was very obvious, yet the market decided to do what it did, buying first, asking questions later, aka the donkey mentality. So for now, we have to forget about the stimulus, which means that the US dollar will recover. We'll talk a little more about that in the charts. But for now, let's cover some earnings that we had today, starting with Delta Airlines. Delta Airlines, of course, reported a loss of over 80% of revenue. That was expected. And when you add this quarter with last quarter, Delta Airlines lost over $11 billion in revenue. That's the bad news. What about the good news? The good news is after all the furloughs and the firing of employees, they have managed to reduce their daily cash burn from $27 million to $18 million instead. Furthermore, Delta has about $11 billion cash on hand right now in combination of the bailout money and the treasury loans, which basically means that Delta in cash terms covered all of their losses in terms of revenue. Now that doesn't mean that the cash substitutes lost revenue, at least not in the long term. It does in the short term, but not in the long term. And we are in a pivotal point here for airline carriers. If they do receive a second round of bailouts and we see just a smell, a hint of recovery in the fourth quarter, which should have heavy traveling due to the holiday season, that would be a very bullish catalyst for airline carriers, specifically Southwest, because Southwest managed to score bailout money. And assuming if there is a second round, they will score more. Yet they have not lost as much revenue as say Delta or United or American Airlines did. So we'll keep that in mind. But for now, moving on to another earnings report from JP Morgan Chase, aka the Landromat. And we call it that because they've been caught washing money according to the FinCEN revelation to the mob, Russian oligarchs, and drug cartels. So looks like they're running a very ethical business over there at JP Morgan. Speaking of course, before we cover the earnings, we need to cover the CEO of JP Morgan, Jamie Dimon, aka the sweetheart of Wall Street. Jamie Dimon, of course, is very beloved in the Wall Street community, yet a lot of people forget the history of Jamie Dimon, who, by the way, was involved in the 2009 housing crisis, and he is the last survivor of the banksters who orchestrated that tragedy. All the other bank CEO either resigned or they got replaced, but Jamie Dimon is still there. And of course, Jamie's trying to be woke, and he takes a knee down, and he slashed employees' bonuses because they failed in their diversity efforts. Meanwhile, he is the leader of the organization, and he does not slash his own bonuses. If there's a failure in diversity efforts, then shouldn't Jamie Dimon get a bonus cut? No, it doesn't work that way. The employees get the punishment, not the boss. And of course, he talked about promising $30 billion for diversity and blacks and Latinos, trying to be as woke as he can. Yet of course, who kicked black families out of their homes during the 2009 crisis? Who took money out of thin air, created money out of thin air into the Fugazi mortgages, approving people, letting them into homes before foreclosing the homes and repossessing those tangible assets, kicking the families and keeping the homes. Therefore, that money that was created out of thin air is now transformed into tangible assets for JP Morgan and Jamie Dimon. But of course, since Jamie Dimon been washing money for mobsters for a while now, he learned how to talk tough, and he decided to run for president or announced that he's interested in running for president, and he trash-talked President Trump.
You're not going to get a wealthy New Yorker elected president. Boy, I was dead wrong. And by the way, this wealthy New Yorker actually earned his money. It wasn't a gift from daddy. And I grew up in a poorer part of Queens than he did, but I am a banker. I am part of the elite. I don't think the American public looks at Trump as part of the elite. They look at him as the upstart who punched the elites in the nose every day. Because I'm as tough as he is, I'm smarter than he is, I would be fine. He can punch me all he wants and it wouldn't work with me. I'd fight right back.
And of course, it took Trump one tweet to completely crush Jamie Dimon and demasculinize him completely. And Jamie Dimon announced right away that he's not even thinking about running for president. So tough guy Dimon folds right away. But continuing on the crimes of JP Diamond. Of course, we've heard the reports that their commodity desk been running a scam in the gold and silver pricing fixing, and the US government called that desk in JP Morgan a crime ring. Furthermore, certain JP Morgan employees got caught red-handed stealing from the PPP loans program and engaged in quote-unquote illegal activities. And with that bright background on JP Morgan, let's review their earnings. The results, of course, beating expectations and producing about $30 billion in revenue. By the way, Tesla is valued more than JP Morgan, even though JP Morgan makes in revenue terms in one quarter what Tesla makes in a year. But here we go, continuing. You might have heard from the media that JP Morgan had a decent earnings report. On paper, yes, but when you dig in details, not really, because all what they did, of course, is they reduced the provisions, aka the cash they keep in reserves to cover bad loans. Jamie Dimon decided to make a cute trick today, and he said that we don't need any provisions besides just $611 million. Expectations, of course, were for at least $800 million, if not in the billions. And that is the reason why, the only reason why JP Morgan results look good. But if they did the right thing and they added what they needed to add in the provisions, the results would have looked bad. Just keep that in mind. Yet the market, of course, caught up to it, and you saw GPM shares trading in the red today. Now, Diamond says that they have over $34 billion in reserves allocated for bad loans. That is a huge number to begin with, but it also illustrates the risk, the potential risk of defaults in the economy. And perhaps the market wanted to see JP Morgan allocating a little more to be on the safe side rather than taking unnecessary risks. And of course, continuing, here you go. Jamie Dimon says that the base case for the economic outcome will leave JP Morgan with about $10 billion in excess from the reserves, meaning that they're already covered, and in the base case, according to Dimon, JP Morgan will be left with $10 billion extra after they cover all the bad loans in the economy, associated, of course, with their bank. Here is the catch. In the worst case scenario, this is according to Dimon, not to analysts or the experts, JP Morgan will be left in the hole by the tune of $20 billion. Furthermore, you saw in the earnings report the $920 million fine that JP Morgan had to pay the US government to settle for all their crimes. And of course, in addition to that, about $500 million for legal fees. I'd love to be the lawyer who defended JP Morgan in this case and managed to cash over $500 million. And lastly, of course, here is the core business for JP Morgan, just to see and illustrate the weakness in the banking sector overall. Consumer banking and their interest revenue from the Fed down 9%, but here is what saved JP Morgan's ass, and perhaps the only shining light in banks' earnings overall. We talk about the casino and the Robin Hoodites and the gambling mania in the stock market, and here you go. The trading revenue for JP Morgan was up 4% to the tune of over $6 billion in revenue. And that is, of course, what pushed JP Morgan results, in addition with the cute tricks they did with the provisions, above expectations. Now let's look across the street for Citibank earnings. Not so good. If you thought JP Morgan was bad, Citibank is abysmal because their profits are down over 34%. Yet you see the bright spot here is trading revenue. Yet again, Citibank managed to make about $4.6 billion from the gambling mania in the stock market. And of course, that will raise expectations for Goldman Sachs and Morgan Stanley. Goldman, of course, reporting tomorrow because these names are more associated with trading revenue than traditional banks. We'll see how Goldman does. But for now, moving on to perhaps the most important event of the day, the Apple event and revealing the iPhone 12. Right away, you see the morons cheering for outdated technology. The new iPhone doesn't even come with a fourth camera as expected. It only comes with 5G. That is the main feature. The rest is all outdated tech. Even, by the way, the 5G, because we talked about Samsung having a 5G phone last year. But here we go with the stupidity. Here is a new feature, ladies and gentlemen. Welcome to the 21st century and new innovations from Tim Apple. The new iPhone comes with a magnet. Oh, it also comes with a camera sensor that Samsung had earlier in the year. Oh. And here is a list of all the features that the new iPhone will sport. And look at that. It is water and dust resistance. Oh. But perhaps the most important feature that the new iPhone will have is it will not come with a charger or headphones to begin with. And Apple says that they're doing that to reduce their carbon footprint. And what do you know? The next thing from Apple is they're just gonna send you or ship you a box, an empty box with no phone included, to quote unquote reduce their carbon footprint. We all know that this is a scam. They just want to show us on paper that they're reducing the prices of iPhones. But in reality, when you add everything together, you have to buy the charger separately and the headphones separately and the cameras separately. All of a sudden, you're paying a fortune for the iPhone. And if you're interested, here you go. Here is the pricing for the new iPhone 12. The vanilla version comes at $699 and the chocolate at $999. And if you want the real deal, the extra dark chocolate with a whipped cream on top, that will cost you $10.99. This is the pro version, of course, but remember, it's not going to come with a charger or headphones, anything like that. Even the brochure, you have to pay separately for that. But this leads me, of course, to the absurdity of the phone business, the smartphone business that is. Samsung is now being beaten by Apple in terms of prices. And I get it, Samsung includes headphones and chargers in the package. Still, when the new iPhone, this is the premium version, costs $10.99 on paper, yet the Samsung Note 20 Ultra, the 5G phone, cost about $1,500. It's a little absurd from Samsung here. They need to review their pricing because we're in the middle of a pandemic and they're not even trying to compete with Apple here. Now, you might have heard that there is Prime Day on Amazon and the new Note 20 Ultra is being sold for $1,100 or so. This is the discount, of course, but still it is more expensive than the new iPhone, at least on paper. Not a good look for Samsung right here. Moving on to the charts analysis and starting, of course, with the S&P 500, the SPY. Here is a 15 minutes chart. We talked about the sky is the limit for the SPY, yet we see noticeable weakness today. So we have to underline new support levels. And of course, you know by now, the previous gaps that we did on the way up become support and the next goal to reach on the way down. So that makes the first support at 346.80 and the second support at 343.70. Moving on to the daily chart of the SPY. You see right away we reversed before we even reached the top of yesterday's candle. That is bearish behavior on paper. But we do need to look for more indicators in the market, and for that we will move on to the Nasdaq, the Qs. 15 minutes chart beginning with the bear case. The bear case says that we're making a series of lower highs and lower lows, and that of course will result eventually in a breakdown in the Qs. Contrast that with the bull case from a 15 minutes perspective, of course. The bull case says that this is a bull flag information and it is a matter of time before it breaks to the upside. So from a 15 minutes perspective alone, it is inconclusive. We can't get any valuable information. So let's move on to the daily chart and try to extract more info. Right away, you see the reverse head and shoulder formation playing out to the bullish side. And now what we did is we failed to reach the top candle from yesterday. That is bearish on paper, but you have to keep in mind that we did manage to close above yesterday's closing. That is bullish. So again, contrasting information here. We can't make any conclusions from looking at the SPY or the Qs alone. So let's continue and investigate further. What's going on with the VIX? The VIX caught support multiple times, touching and retesting the support. This behavior eventually leads to a breakout to the upside. Testing the support, making sure that it is solid, gives any chart in typical charting behavior the green light to rally. So a little caution signal here from the VIX, and you saw the VIX rallying just by a little bit today. What's going on with the DXY, the dollar index? Here we go, the 50 minutes chart. As we talked, of course, in the VIX, when you test, retest support levels, eventually you break to the upside. And you see here the triple bottom we had at the 93 level, and now we departed away from that, and the DXY managed to recapture the former support of 93.50. That is very bullish behavior in the dollar index chart, and I warned you even before the week started that I'm smelling a trick in the dollar index, and we will eventually see the ABC pattern from a daily chart perspective or even a weekly chart perspective taking place. This is the bullish ABC pattern. The mirror image side of that pattern can be seen in gold. If the DXY will execute a bullish ABC pattern, you know that gold will execute a bearish ABC pattern. You saw, as I told you, gold struggling to break above 1925, the resistance, and now you see it reversing from that level, trending downward, and perhaps paving the way for the ABC pattern to take place. Here is an interesting chart of the TNX, which tracks the 10-year Treasury yield. No markings or annotations by my side. Now, switching the chart to a line pattern and comparing it side by side with the NASDAQ 100. And as you can see, when the TNX tops, it is a leading indicator that we will face a top in the NASDAQ 100. I did mark the tops in the TNX, which is in the green, different colors in parallel with the NDX in red, to show you that once we top in the TNX, it is a matter of time before we top in the NASDAQ, meaning that a reversal in the TNX is a leading indicator that a reversal in the Qs will follow. And we did see the TNX down over 6% today, a massive reversal to the downside, indicating a reversal in the Qs. Very important hint that you need to keep in mind. Furthermore, looking at the NASDAQ VIX, the VXN, this is the volatility index that tracks the NASDAQ specifically. And as you can see, when you compare it with the NASDAQ 100 in a line chart, what you find out is the moment the VXN starts to rally, regardless whether the NASDAQ is rallying or not, you see a lag in reaction, but what happens eventually is the NASDAQ trending lower, and it is illustrated in the chart right in front of you. What do we see right now? As the NASDAQ trading higher, so is the VXN, the NASDAQ VIX, indicating that we are seeing a lag here, and it is a matter of time before the NASDAQ reverses to the downside, and we see a huge pop, even bigger than today, in the VXN. By the way, the VXN was up over 3% today. And here is the last chart of the day, Apple, the most important chart of the day, of course, from a 15 minutes perspective. You can see the importance of the 120 level being support in the beginning of the day and then support yet again as the shares started to flush down. Breaking 120 will be very significant and will cause a sell-off that could take Apple shares all the way back to the 113 support. Now notice from a 15 minutes perspective, right away we saw a huge bear candle, red candle, engulfing candle in the morning. That was your first warning signal. And then we saw a formation of one bear flag that played to the downside. And by the end of the day, we've seen a formation of another bear flag, which started to play to the downside. However, the action was halted due to the closing bell. So on likelihood, we will see a continuation of that bear flag tomorrow, and Apple will decline and trade in the red if the charts are correct. And now let's move on and conclude the video. We talked about sell the news about Apple's event yesterday. You saw that taking place today. We have, in addition to that, bad news in terms of the vaccine trials That had an effect in the reopening names. So we do have bad news for both sides of the trade here, the stay-at-home stocks and the reopening stocks. So what will be the market's reaction now? We know the market doesn't like to sell off and take profits off the table regardless of the conditions and the threats. All they do is playing the yo-yo game, switching from tech to reopening stocks and then back and forth following the news cycle. But we are getting very closer to a scenario of there is nowhere to hide. Tech names had a pop and now they have to correct. We do have their earnings looming around. We do have bad news for the vaccine. So where are you going to hide? Today, we've seen noticeable action from the rise of the dollar index and the rise in bonds prices, which means a decline in yields, meaning that some market participants at least are starting to shift into bonds, and we are starting to see the formation of the panic trade. Higher dollar index, lower yields, and you see the VIX popping higher. And what do you know? You're now paving the way for an overall correction scenario in the market, meaning that there is nowhere to hide. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.